As you look at the markets you look at, whether it's fixed income or it's on the equity side, how much of the market's reacting today to just what the Fed is doing rather than any underlying fundamentals?
No, you're definitely right. I mean, the markets, you could debate the markets overshooting. I mean, you think about the day they had, like you said, what the Fed did is a ripple through the market. I mean, parts of the high yield market and credit markets, it's a virtual tidal wave of the impact that it's having. Markets tend to overshoot, but I think when this is a very, very unique circumstance, it's different than '08, and different than maybe any other crisis. And that we do think the economy is going to rebound. And we do think, we think you could have a second quarter that is something like an annualized run rate of 30% decline in the economy. But we think third quarter, 12% up, fourth quarter, you get 8% up. And then next year, we're going to have the stimulus will still be working through the system. You'll have a pretty good GDP number. We think over 5% the year after. So, listen, I think the markets are right. The markets shouldn't go back to where they were. But you're getting closer to factoring in the what's happened and this immense amount of stimulus that I think the markets are rightfully adjusting to.
So Rick, how is the way you put money to work today different than it was yesterday, given what the Fed's done? As an investor, what does an investor do today that they wouldn't have done yesterday, or vice versa?
It's a big deal. I mean, we are. If you go back a day, 24 hours ago, the way you thought about, if you were a AAA asset because the Fed was getting at that, if you were a high quality, that you were in good shape. If you were an investment grade bondholder, credit holder, you were in pretty good shape because the Fed was there, certainly in mortgages. But you've now extended this, and that the high yield market, it's definitely supportive of companies, not just the high yield market, but a lot of the BBB companies that are going to go into high yield. That those actually become a lot safer. The CLO market or the loan market generally, with the Fed providing what is functionally, not to get too technical around what's happened, but the Fed going into that CLO market, the AAA part of the CLO market, lifts a lot of what was blockage in the system around loans. So that gives you a lot more comfort. And, quite frankly, I think the equity market reacts to what is stable financial conditions and a bridge from here to there, and so to take on some more equity risk, I think is makes some sense. And we're doing, I think, like a lot of people, we've been running high levels of cash in our portfolios, and because the uncertainty was so great, given how much stimulus is coming in from fiscal as well as the monetary side, you can take a little bit of that cash. You still should run high levels of cash, but you can spend some of that money even in the markets that you were less willing to do it a day ago.